Roth conversions are one of the most powerful tax planning strategies in a retiree's toolkit. However, optimizing conversions can be difficult and oftentimes complex. In this video, I'm going to answer 13 frequently asked questions around Roth conversions. We have timestamps in the description below if you want to jump around, but also know that we have a whole library of Roth conversion videos, and I don't want this video to simply be a repeat of past videos that we've recorded. So I try to choose common questions that I maybe haven't answered before, or as you'll see with this first question, one I've answered, but we keep getting questions about. For those that aren't familiar, a Roth conversion is a strategy where you take money from your traditional IRA, you pay taxes on that money or a portion of that money, and then you convert it into a Roth IRA so it will never be taxed again. In a way, you're essentially paying taxes on your timeline rather than being forced to pay taxes due to RMDs and different issues that might come down the road from those traditional IRA accounts. Well, the most common question we get on our Roth conversion videos, isn't there a long-term cost to a Roth conversion because of the taxes that you pay today? If I have $100,000 in an IRA and I convert it at 15%, now I only have $85,000 working for me and growing. Won't it take a long time for that $85,000 to catch back up? But let's say we assume 7% growth, and it really doesn't matter the time horizon, whether we're looking at 10, 20, or 30 years. If we don't have any withdrawals from those accounts, they'll never catch up. You're essentially comparing apples to oranges. You're comparing after-tax value to pre-tax value. Instead, you need to compare the net or after-tax value of both. This means that all of the math for a Roth conversion comes down to the rate you pay on a conversion versus the rate you would otherwise withdraw those funds at from your IRA at some point in the future. If you paid a 15% tax on the conversion versus paying a 15% tax on any withdrawals from the IRA, as you see with the example on the screen, you would have a completely equivalent scenario. Now, this is showing a 7% growth rate, but it wouldn't matter if it was an 8%, 9%, or 50% annual growth rate. It all comes down to the tax rate on the withdrawal and the tax rate on the conversion. Now, if we were trying to meet an $8,000 net income goal, to get $8,000 from the IRA, you would actually need to withdraw about $9,400. After 20 years, both scenarios give you $160,000 of after-tax income with $959 left over. So let me say this again. There is no growth cost to paying taxes today on a Roth conversion. It all comes down to rates. There is a cost of paying too high of a rate today, and there is a benefit of paying a lower tax cost today. It all comes down to the rates. This is good news because it actually simplifies the process quite a bit. To prove this out further, let's use the same example. And we're going to still pay 15% as a tax cost on the conversion, but now we're going to look at withdrawing that income at a tax cost of 20%. Now you'll see there's a significant benefit difference. The Roth conversion leaves you with more income or a larger legacy, depending on how you look at it. Question number 2, should I save up cash to brace for Roth conversion taxes? Let's say you are in your final years of working and you're looking to convert for, let's just say, a 3-year period when you first retire. Should you save up cash to pay for those taxes? Well, if you're asking this question, you've probably seen our video or others talk about the best place to pay conversion taxes from, and that would be your savings or your taxable account. Because of this, I know some retirees without much in savings feel pressure to save into these accounts just to aid in Roth conversion strategies. And I hope with this question I clear up some of this confusion. Yes, if you already have savings or a taxable account, this is the best place to pay conversion taxes from. But that doesn't mean you should start these accounts or accumulate more in these accounts just for the sake of paying those conversion taxes. The reason these are a priority in your Roth conversion strategy is because these are generally leaky bucket accounts. Interest, dividends, capital gains are all taxed to you from these accounts on an ongoing basis. Because of this, there is a growth cost to paying taxes each and every year, unlike a Roth conversion where you're paying taxes that one time. But again, this doesn't mean you should create a leaky bucket account if you don't already have one. If you are saving money into a cash account for tax purposes, what are you actually doing? Let's say your marginal rate is 30% between Fed and state taxes while you're working. Well, to save and accumulate cash, you're paying a 30% tax on whatever you save into that account. In retirement, let's say you're converting at 12, 22, and 24%. Well, you just saved cash at a 30% tax rate to pay for a conversion at a lower tax rate. That doesn't exactly make sense. Instead, rather than accumulating that wealth in terms of savings accounts, what if you contributed more to your 401k? Well, you would get a tax deduction on whatever you contributed and essentially save that 30% tax. Now in retirement, when you converted, you'd simply then pay the taxes right out of the conversion. If you're converting at, let's say, 22% and you're paying conversion taxes at 22%, this makes a lot more sense than converting at 22% and paying conversion taxes at 30%. Now, the one caveat here is if you've already maxed out your 401k, traditional IRAs, and some of those other accounts that might have a tax benefit, then savings is really all that's left, and there's really no issue then with building up some cash. Question number 3, what softwares do we use for retirement planning and tax analysis? All of the charts that we show on the screen through our various videos. This is one of our most asked questions in general. Within the past 6 months, we've actually started using a software piece that we developed in-house for our Roth conversion analysis. This is not yet available to the public, but we plan on it being available in the future. There are so many small variables that we've talked about in past videos that just simply aren't included in off-the-shelf software packages. And so we essentially were forced to develop some solutions in-house. But if we talk about off-the-shelf solutions, the two main software packages we use for forward-looking analysis are called Money Guide Pro and Income Lab. Now, to my knowledge, you need to be licensed within the industry to use either of these software packages. But no, it's not something I've researched heavily, and again, you can do your own research if you're looking to use any of these solutions. Then finally, we use a software package called Holistiplan for year-by-year tax planning. One thing I will say here, every software package has its deficiencies. Part of getting the most out of any tool is understanding where those deficiencies lie and how to work around them. Question number 4, when do I have to pay the taxes for my Roth conversion? This is one of those topics that can get a little bit more complex because you have a different set of rules based on how you pay your Roth conversion taxes. Yes, not only does the government have rules for having to pay taxes, but you also have rules for how to pay those conversion taxes. Now, if you're paying from a savings or taxable account, you will have to make what's called an estimated tax payment, either through the mail or directly online. You need to explicitly send the government those tax dollars. With estimated tax payment, the government essentially expects you to make payments based on when those taxes were accrued. For instance, let's say you perform a Roth conversion in August. You need to make a full tax payment by September 15th, or partial payments by September 15th and January 15th. Basically, you have a shorter timeline on making those tax payments when you're making an estimated tax payment. I have a video right here in the upper right-hand corner that will explain this a little bit more. If you're paying taxes right out of your conversion or withholding from your IRA or your Roth IRA, then you just need to withhold by December 31st. It doesn't matter if you performed a conversion on January 1st or December 30th. You have one clear deadline. This should be considered when you think about your tax payment plan. Question number 5. I'm behind on conversions. I have a lot of tax paying ahead if I don't do anything. What do I do? Should I perform large conversions right away or as soon as possible? This question is typically generated from 2 insights. Right now is a great time for Roth conversions due to the Tax Cuts and Jobs Act that is set to expire in 2025. Said more simply, in 2026, taxes are rising. And then number 2, typically your 60s is the best time to perform Roth conversions. And so let's say we have someone that's 67, missed out on the conversion window they've had in the past because they either didn't realize they had a tax problem or they just recently learned about Roth conversions. Let's say this person is single and they have some sizable IRA assets. Well, looking at this client's forward-looking tax graph, you can see that they have required minimum distributions that start from these IRA accounts at 73 and pretty quickly push this retiree right into the 28% tax bracket. Now, they would see numerous Medicare penalties here as well on top of paying those higher taxes. Well, it's important to understand that sometimes eliminating a tax problem isn't the goal because it can't be done prudently. Instead, some retirees are in what we'll call a minimization situation. For instance, let's say they maxed out the 24% bracket for the next 3 years inside of that Tax Cuts and Jobs Act window. Well, we're converting at 24% to avoid paying 25 and 28% later. We showed by answering the first question that this makes a lot of sense. But once we do this, we still see they have some tax issues. They're still being pushed into the 28% bracket. Well, I don't love this, but what are we going to do about it? It wouldn't make sense to convert at 32% in the next couple of years to avoid 28%, but that's initially where a lot of people's thoughts go. Well, there are some additional opportunities between years 3 and 10, as we see on the screen, to max out the 25% bracket and hopefully avoid being taxed at 28% altogether. But this is really becoming a pick your spot type of game. Now, we're going to pick up smaller $10,000 or $40,000 conversions as we move through time, just having a little bit extra space either in an IRMA bracket or in, let's say, the 25% bracket. But we're not going to be able to flip a switch and essentially eliminate RMDs in a prudent way. And so it's about finding the lowest rate we can attain over time. In this situation, that still leads to conversions, but again, it's not a completely elimination situation. It's minimization. We're going to take questions 6 through 10 in a little bit more of a rapid fire manner. Are there income or size limitations to Roth conversions? No, you can convert a $10 million IRA all at once if you so wanted to. We know that wouldn't be prudent, however. You could also make $10 million a year and still perform a Roth conversion. There are no income or size limitations to Roth conversions. Do Roth conversions only make sense because of the Tax Cuts and Jobs Act? Now, we touched on this briefly, but the Tax Cuts and Jobs Act is set to expire in 2025. Right now, we are in lower tax rates than we will see post-2025. Because of this, Roth conversions are souped up a little bit, if that's what you want to call it, supercharged a little bit. Come 2026, we will see that Roth conversions still make sense for a lot of retirees, but they probably won't be as obvious, and it'll probably lead to slightly smaller conversions than we would be looking at converting today. Can you do a conversion if you're under 59 and a half? And know that you can do a conversion at any age, but there may be penalties if you pay those conversion taxes in the wrong way. What I mean by this is if you withdraw from the conversion or withdraw from your IRA and then pay conversion taxes, now you're making an early distribution. It counts as an early distribution even though it's going to the IRS. And so you'll owe a 10% penalty on any amount that you take out of your IRAs for conversion taxes, but you can still perform the conversion and pay those taxes right out of saving. Next question, what are some benefits between converting while working versus converting while retiring? The biggest benefit when you're retired is typically you're in lower tax brackets because you don't have the working income filling up some of those lower brackets. So you can live off savings and still be able to convert a few $100,000 per year and do so prudently. The biggest benefit for converting while working is typically healthcare related. Let's say you retire at 60. Well, many retirees go onto the Affordable Care Act system, which means it's quite costly to start to show larger income. Therefore, it becomes quite costly to convert. Then after ACA, you go on to Medicare and now have to worry about Medicare penalties like IRMA. If you show too much income, you're going to have increases in your Medicare expenses. Now, these are both hurdles that are not there for you while working because, for instance, for Medicare, you can submit an appeal and get those Medicare penalties reversed. And so for those with reasonable income but not significant working income, know that you can convert on top of your working income, and in certain situations that can be quite beneficial. Number 10, should I convert my IRAs first or my spouse's IRAs? In the vast majority of situations, it makes the most sense to convert the older spouse's IRAs first. This is because they will hit that RMD age first, which is typically that catalyst that leads to a lot of tax problems. Now, there are scenarios where we'd want to adjust this, but again, most often you want to convert the older spouse's IRAs first. Question number 11 is one that I've gotten more frequently as of late. What happens if I Roth convert a bunch and Congress later decides they want to tax withdrawals on my Roth IRA? Now I paid taxes twice. This is a crazy question to me, but one I get more often than I'd like. What if Congress decides to not only tax you again, but seize all of your retirement assets? What if they abolish Social Security and pull the rug right out from underneath every American who has paid into the system? Look, we can what if ourselves to death with crazy scenarios, and it seems some love to do this. My recommendation, don't give it the time of day. The reason the government allows Roth conversions is because they're still getting their tax dollars. They are as likely to retax your Roth assets as they are to retax the savings you have in your bank account. Question number 12, fixing a Roth conversion mistake. Every January to April timeframe, we receive panic questions from retirees who watch our YouTube channel, inquiring about reversing a Roth conversion mistake. They've either converted too much or converted the wrong way and now face a number of issues because of it. So the question is, can you reverse a Roth conversion? Well, you used to be able to prior to 2018. This is technically called recharacterization. Unfortunately, as part of the Tax Cuts and Jobs Act, this ability was completely eliminated. So now if you perform a Roth conversion, it is permanent. Be careful because of this. Then lastly, number 13. I've heard that I have to wait 5 years each time that I convert in order to be able to withdraw that conversion. Is this true? If you are younger than 59 and a half, then yes, this is true. You can't perform a Roth conversion at age 51 and start to use that converted amount at age 52. You need to wait 5 years, otherwise you will have a 10% penalty on whatever you withdraw. But if you are over the age of 59 and a half, you no longer have to follow this 5-year rule. You could convert at age 61 and immediately use that Roth money at age 62. Make sure you're adequately planning for this rule if you're younger than 59 and a half, and don't let yourself be confused by it if you're over than 59 and a half. Now, if you have a question that I didn't answer in this video, let me know in the comments below. Oftentimes we receive enough questions, I'd be more than happy to record another frequently asked questions video just like this one. Also know that Roth conversions can be extremely powerful for many retirees, but the number one thing that ruins the value of a Roth conversion is making a common mistake. I have 5 common Roth conversion mistakes in this video right here. Click on this video to learn more, and always remember, you don't need more money, you need a better plan. Thanks for watching.